Welcome to the daily update, where I'll go over the action in the market for Wednesday, May 14th, and we'll see how things look for Thursday, May 15th. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. I was unable to post the daily video for Wednesday, so I went back and looked through all the charts and we'll reevaluate things. We're looking pretty positive, but maybe a little tired right now. The market's had a really good run over the last few days, and the announcement last weekend with the U.S. China trade talks, the market's still kind of rolling along based on the optimism from that, but we're seeing a few negative divergences now, mostly in the short term, where price is still going up, but we're seeing some weakness starting to drift in. Again, just more on a short-term basis. So we'll just evaluate things as they happen and see if it's turning into something a little more substantial. But for right now, I'll point those out as I go through the charts. Okay, so right at the open, it was a pretty sleepy day. We did have a higher open, not much, no gap or anything, but we got near the 5,900, which now that's the next big level that the market is dealing with. And as I usually say, these are not necessarily technical levels, they're more psychological levels. But the market deals with psychology just as much as it does with the fundamentals and the things that go into stock prices. So right about at 5,900, we then chopped above and below the unchanged level in the daily pivot at 5,879. Then we just kept chopping sideways. We were in a small range between 5,900 to the upside and the daily pivot, more or less to the downside. We held on to that area and we closed slightly positive. It was virtually unchanged, but up a little bit, so it goes in the books as an up day. We were up 0.1% on below average volume. We're starting to see that drop off. And we are positive in the short, intermediate, and long term, but we're still dealing with a long-term downtrend. Not a bear market, just a downtrend. Now, we're above both the moving averages, and the longer we stay above those, the more that downtrend could see a golden cross and turn into an uptrend. We're getting concerned about interest rates. We're up over the 4.5% range now for the 10-year yield. We're at 4.53%. This is about when stocks started to focus more on interest rates and get a little concerned as rates are going back up. Now, at the same time, look at the context. There's been a lot of flip-flopping now where early part of April, everybody was revising their forecast down because we had already dropped. Now that we're going up, they're revising their forecast back up. So is the rise in interest rates having to do with perceived economic strength looking out into the future? Or is there something else going on? But at some point, stocks are going to notice that, ooh, interest rates are going up. I'm not really happy about that. That's going to start biting into corporate profits and really lessen the amount of liquidity, perhaps, that's available to buy stocks. And we could see some weakness coming out from that. And we're pretty much beyond earnings season right now. We've kind of finished it out for the S&P 500. There's a few companies that will come out. I know United Healthcare posted their earnings a day or two ago, and that really put a drag down on the Dow. But we're kind of not really focused on that, and I'll go over that in the weekend video. And the debate about whether we're going to go into a recession or not, it's now switching back. You're seeing a lot of revisions to where, well, we think it's 35, 40, 50% that we're going to go into a recession. Of course, the perma bears, it's 100% all the time for them. But now that the market is perceiving that there's economic growth coming into the market, and those revisions are starting to come down a bit. And that's really kind of the wave that's being ridden for the time being. Okay, so some comments. Actually, this was after Tuesday. We are seeing the S&P positive now year to date, where we had been down as much on an intraday basis, down over 20%. So the S&P's really made a good shot at coming back up, and a lot of the indexes are really improving. And we did see where mega caps, semis, and growth are outperforming. Those are the areas that are doing better now. Some of the negative divergences that we're seeing have to do with other areas of the market. We're under 20 now with the VIX. We're still high relative to what we've seen over the last few years, but we're coming in at 18.62 for that. If we tend to stay under 20, I'll probably drop this out of the note. It's just, especially when we go over 20, that's when we really pay attention to the VIX even more than we already do. And we see our usual charts on the list: the Stochk RSI, Williams percent R, CCI 14 and 20, and stochastics. Those are usually on the list when we're seeing good momentum. The ones that aren't on there as much are the rate of change going back 5 days, 10 days, 20 days. We're still quite a ways away from the 20 period moving average. That's the boom indicator, meaning that it's getting an extreme reading. We're getting far away from that, and price has a tendency to come back. The slope oscillator is still giving us a very high reading, and then the short-term RSI. In the intermediate term, we're still getting a high reading from the CMB composite. We're still up into the +3 channel with the standard deviation chart. TTM squeeze, very high reading there. And the bullish percent indexes for the S&P and NASDAQ 100 still looking a little. Now, the bullish percent index actually declined, and it's still positive though. But we're coming down after giving a pretty extreme reading. And then we're also far away from the 50 period moving average, and price has a tendency to come back there too. No real change to the overall scenario. The Fed seemed, at the time they made some more substantial opinion about where they think things are going. They're fearful that inflation is going to go up and economic growth is going to go down. And we're kind of still in that mode, even though the market is trying to anticipate just the opposite. Now, we could see inflation go up, and I'll go through the CPI report because I couldn't do that in Wednesday's session. I'll show you the charts for that. And that might, at least on a shorter term basis, that might cause some problems there. The dollar was down and interest rates were up. Again, we were at 4.5% after Tuesday. We're at 4.53% after Wednesday with the 10-year yield. This is when the market gets concerned about that. We're still positive from a sentiment aspect. We camped out below 25 for April and part of March and even into May, but now we're seeing things shifting a bit. We're not extreme yet. We're at 70. If we get up to 75, that's when we start to get extreme with the sentiment, where we had been at 68. And we're not inverted with the 10-year to the 3-month. Another day or so, and if that doesn't go back to being inverted, I will probably take this off the list as well. And we're almost into a trend now with the ADX. It's trying to turn up. In the short term, we already are trending. And I'll show you that chart where we're starting to cross above the moving average. So we're showing a strengthening trend. I'll kind of have to qualify that a little bit. We're still below 20, so we're not trending from that aspect, but we are turning up and going above the moving average in the short term. We haven't crossed above the moving average yet with the intermediate term chart, but we are positive with the green line above the red line. With the up day, as minuscule as it was, our bias is positive and our momentum is positive. So now I'm going to go through some of Tuesday's reports and then Wednesday's reports as well. We did get the April NFIB small business optimism, came in down a little bit at 95.8, where it had been at 97.4. CPI, this was the big one. The headline number came in less than expected, up 0.2%, and the market liked that, where last time it was down 0.1%. And the core CPI, this is the inflation component, also came in less than expected. And that's why we saw a good day on Tuesday, where last time it was up 0.1%. And then Wednesday's reports, we just had the weekly MBA mortgage applications index up 1.1%. A week ago, it was up 11%. So here's the charts of the MBA mortgage applications, down but still positive from the previous reading. We are seeing a gradual decline here with the business optimism here. It's not as bad as it was before, but it has been on a decline. Some of this has to do with the tariffs and uncertainty about what's going to happen with the economy. And here is the CPI, the year over year. The total is going down. That's the blue line, and we're pretty much flat right now with the core. So the market likes that. It's not necessarily going up right now. And then year over year, we're declining with the services. If you take out energy, I have to move this bar. And then the core commodities, this is coming up a little bit, and that could be a little bit of a concern from an inflationary standpoint. Then here's the chart that I show. First on top, I have what's the change over a year ago. That's the rate of change over 12 months. Pretty much flat, actually slightly declining here. And that's what the market likes, but on a month over month basis, it did go up. And then the core CPI, again, we're declining just a little bit here with the 12-month rate of change, where we did actually end up going up with the 1 month change. And then I do have some extra charts here. I picked out a few from Wednesday that I think should be included in this video because I didn't get a chance to do that in the daily video. And this is something that I hit over the weekend in the intermarket analysis video where we talk about valuation. And we have been going up with the S&P, so we're at 21, and we use that 10, 15, 20 scale. When we're above 20, that means we're expensive. And then there are parts of the market that are even more expensive, where we have staples, industrials, tech, and discretionary. These are all well over that 20 level, so they're considered to be expensive. And then energy and healthcare, these are two, especially healthcare, that's more defensive. Energy's been really just having a difficult time right now. They're coming in at more being fairly priced on that 10, 15, 20 scale. And quarterly US and non-US share announced buybacks. And again, these are announced. It's one thing for a company to say, we're going to buy back our own stock. It's another thing for them to actually do it. So, and I showed a chart, I believe, for Tuesday where there's a big spread between the companies that announce they're going to do a buyback and those that actually end up doing it. But this takes US and non-US together, and it's still looking pretty healthy right now, at least in the announcements. The annual realized bottom-up consensus and earnings per share. This is what we're really keeping an eye on here because we still see earnings positive, but less than what we were seeing before. And this is for the S&P, where 2024, that's the light blue, and then this is what they're anticipating here for 2025. It's positive, but down from previous readings, and then looking out to 2026, a lot more rosy, and it's easier for analysts to come up with, hey, down the road, everything's going to be great. I'm just not sure what's going to happen right now or at the present time. And it compares the equal weight with the NASDAQ 100 and all the other indexes. This is the one that I really focus on the most, but this also gives us some perspective from other markets or other indexes. Then the financial conditions index, it has been coming down. It was really going up. And then right around here, this is when everybody is freaking out. This is the April 8th. That's when we saw everything just really struggling at that point. And since that time, it has been coming down. Again, it was starting to go up, and that was helping the market bounce back up. But the fact that this is coming down could put a little pressure on things, but we're not seeing a really big change here. And then we've lowered our 1 year recession odds to 35%. This is Goldman Sachs. They had been up here at about 45%. Now they're coming down to 35%. The Bloomberg consensus has it around 40%. And then cyclical minus defensive positioning. Then as this is coming down, they were worried about the economy. Well, we're seeing some improvements here with the cyclicals and against the defensive. This is the staples would be more defensive, toilet paper and toothpaste. And this is starting to come down a little bit here. But if there's a more positive outlook for the economy, then this will probably start to go back up here. Okay, then earnings above or below long-term growth, that's still looking fairly positive out here. That we have is from real investment advice. There are question marks here because these are all just guesses as to what's going to happen. But this is what the market cues off of. If they're seeing the projections going out looking more positive, then yeah, the market likes that. And then I included the explanation here just to kind of give it a little bit of additional insight. It says there's good news for both. Since 1970, the S&P has gained an average of 16.3% in the 12 months after more than 55% of its components hit a 20-day high. Okay, with positive occurrences recurring 96.7% of the time. And that's what we saw recently here. And that just shows more positive uh, price action more in the short term. Okay. Then the Magnificent Seven, it's lagged the rest of the market year to date. This is going back to the beginning of 2025, and they're usually the leaders, but they are improving. But that's what really has been keeping the indexes either going down or at best kind of chopping sideways. And we could actually take this back into late 2024. That's when we started to see things kind of fizzle out. Yes, we hit an all-time high in February, but it wasn't a real robust all-time high. And then it was not too long after that when we saw things really coming down, where it's the rest of the stocks in the S&P that are actually performing the best. You take the whole S&P, now this is down 3%. This is obviously a few days old as of May 9th here. We're now positive with the S&P year to date. And then, of course, how the Magnificent Seven have been lagging. And then equities had one of the sharpest drawdowns in the last 70 years, but has recovered the orange line. We fell below the average, but then we've been able to get back above that. And we'll have to see, are we going to get back above the average? That could also indicate that maybe we're getting a little overextended in the short term. Risk appetite, starting to see folks feeling a little bit more positive about things. And then the performance outlook for the market, that's also starting to improve after we had become quite pessimistic about things. And then Goldman Sachs raises, of course, we go up, and so you got all these folks raising their target. If we go down, they're going to adjust it again. So the 12-month target they have at 6,200 or so. That's up 11% over the next year. And of course, when we were coming down here, everybody was lowering their targets and trying to come in with downside targets. That's just how that works. And I show this over the weekend as well because there's the Atlanta Fed that comes out with GDP now, and that was contradicting what the New York Fed forecast was because we were getting a positive New York forecast and a negative Atlanta Fed forecast. And when GDP came out, we kind of split the middle between the two. So we were a little bit negative, but they're still coming out looking positive for the time being. And then announced buybacks, again, announced versus what do they really do here. And we're seeing most of the buybacks now in tech, and that could help the tech sector. And that's the major growth area. Financials, that's also positive. Communication, discretionary. These are the big growth areas. Not so much financials, but we do like the financials to do well. That just makes life better for everybody. But this is where we're seeing a lot of the announcements coming from over the last 3 months. Risk appetite indicator, it really dropped down here. Now it's starting to come back up, and folks are willing to assume more risk right now. And then the gap between the hard, that means data behind what's happening with the economy, and soft data, that's people's emotions, that's psychology. And there's usually a pretty good disconnect between the two. We're still seeing it really pessimistic, and that could actually work to the market's favor since we often take a contrarian view of things. And then just looking at the hard data here, that's the dark blue line, and then the soft data where it's coming down. But we were really seeing where people were freaking out. And that's a good time to start thinking in the opposite way of things, even though it will go against every bit of logic that you might have, and certainly it'll go against your emotions. And then earnings revisions momentum, it's starting to turn positive. That's good for the market. And then this is kind of a funky thing. This is high risk themes led market rebound. This is what we were going down when everything was lower. And these are all the different components. We look at the VIX, we look at all these different things that we can use to try to gauge sentiment. And then what over how did they perform? The white dots here performing after the last 5 days when this chart was created. The green area, this is how they've performed over the last month. And since roughly a month has passed since that big downward move, it's making this chart look a lot more positive as well. Then the growth surprises, that's showing an improvement. Inflation surprises are actually going down. That's more positive as well there. Profits growth deviation from the trend. We're actually seeing this starting to come back up with the employment on a year-over-year basis. But when we look at the growth, it's starting to come down. Just a little area to keep an eye on there. And then you probably have heard me talk about this WAG, NYSE breadth thrust. We had one of those recently. Well, there's another thing called a DeGraff, and that's like a breadth thrust too. The criteria is a little bit different, but when you combine those together, okay, even a week later, we're up 71% of the time, and then it just goes from anywhere 100% a month later, sometimes a little bit down, but then it's the results looking out are quite good when we've seen both of these together. And then the credit spreads, this is the spread between risky and not as risky bonds. I haven't been showing that chart lately, mainly because if you see here on this chart, we were really going up and that was causing a concern. But if you looked at a bigger picture of this chart, we still had a lot more room to run before it was turning really scary. We were just noticing that this was going up. Well, since that time, it has been coming down. That's why I haven't been showing the chart because we're seeing fear or sentiment the way I use this chart in the bond market for how are people feeling about things. This is coming down, so they're feeling more positive. And then leveraged ETFs, seeing some improvement here. When the market's going up, folks are willing to jump more into the 2 times, 3 times type of ETFs as well. And then hedge fund exposure, while a substantial portion of shorts have covered, there's still more left. According to this chart, somehow they're able to pick that out, but we're just seeing things improve there. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. Okay, here's the intraday chart. Not an awful lot to talk about. I could go through Tuesday a little bit here. It was much more positive. There was positive reaction to CPI when it came out, and we saw most of the strength coming right after the open. And then we were able to drift sideways and close just a little bit off the high. This was just a sideways move. Now, Thursday is going to be a big day for economic reports, and Jerome Powell's going to be giving a speech. So not a real surprise that we're just kind of going along sideways. We didn't really see much conviction either way, but we held on to support. We came down to the daily pivot a couple of times, but it acted as support, and then we closed slightly positive on the day there. And we're down about 1/4% when I started recording this, about 8 or 9 hours before the market opens. So it wouldn't be surprising if we see a little bit of profit taking coming in, because as I go through the rest of the charts, you'll see where we're looking a little bit tired right now. This is improving, though. We're seeing the blue line outperforming the red line here. So large cap growth is outperforming large cap value intraday, and we're improving with the growth to value ratio for the S&P. This is good. We've been noting that improvement going back to around May 23rd or so. That's when we saw kind of a shift, but we don't really know at that time. We can just say, okay, this is looking better, but then we have to see what is the overall trend, and that's what's improving right now. Where we were up with growth, value ended up being down, and it was down less for the mid caps and down less for the small caps. So we are seeing an improvement with our end of day growth to value ratios. It's looking better here with the small caps, the mid caps, and the S&P. We're still in a downtrend, but the longer we stay above both of these lines, this blue line is starting to turn back up. It's going to take a while, but we could see an actual cross here with the ratio. And we're coming up out of the rainbow now. We spent a number of days inside of this rainbow, and the rainbow's all screwed up now. It looks like a tangled mess, but we're starting to break above the rainbow, and that's more positive there. We are seeing an improvement with the discretionary to staples equal weight. We're still in a downtrend, but we're above both the moving averages. You can see here where discretionary to equal weight, it's breaking out above the 200-day moving average, where we've been going sideways with staples, but now it's starting to drop off. And when you see those things happening, that's why we see this ratio going up. And so I had been pointing this out because the market was getting more defensive. Now we're at least giving it a try here to turn more offensive. When we look at the regular discretionary to staples, that's the weighted sector ratio there. And we are improving with the equal weight. That's the previous chart that I just showed. When we look at tech to utilities, that's improving. Biotech to healthcare, improving, not as robust, but still going up. And then hotels to utilities, that's also improving. And the bellwether areas, semiconductors, trying to make a comeback here. Home builders, they were down a bit, but they've been improving overall. Transports, they're trying to improve, but they gapped up and have just been going sideways. And then retail also gapped up, going sideways. Regional banks gapped up, going sideways. So a lot of the improvement that we're seeing in these charts came from that gap. Retail trying to get back up to its 200-day moving average, and but on a ratio basis, it's not really outperforming at least yet. The overall trend has been that retail's been underperforming the S&P. We are going up with the RSI, but we're getting a little close to that extreme reading there. These are some newer charts that I started to include where, for really, if you go back to February, this is when international stocks started to outperform U.S. stocks. That's when this ratio is going down. That means the international stocks are outperforming. We're possibly seeing some kind of a change here. And this is not a trend line. This is just to accent what's actually happening. And then momentum stocks, and this was more positive. We came down and set a low in March and then set a higher low. This was the big downward move. And that's actually, it was a positive divergence there. And since that time, we've been seeing this ratio actually going back up. And then emerging markets, again, we still have a ways to go to kind of get above this overall downtrend when we look at emerging markets versus developed markets, but it's improving. Large cap growth, we're above all the moving averages. The longer we stay above these lines, the more they will begin to turn back up. And then value is underperforming tech or growth, and that's more positive for the market when we see this ratio going down. As far as our trend, we are now trending, or we are in a strengthening trend, but not an official trend in the short term because we're above the moving average. The green line is above the red line. So we're positive there. We're not quite above the moving average yet with the intermediate term chart. And if we can cross back above it and get back above 20, then we would be in a positive trend, but we haven't done that yet. And picking up a little bit here with our volume oscillator, but we're the last couple of trading days showing where we were under average with volume there. And I wanted to include this one. I usually go over this in some of the weekend videos where I just tell you the numbers in the daily videos, where we were way down here as far as sentiment. And this has really been improving. We go with it while it is going up. We're not contrarian during those times, but we do become contrarian when it gets to an extreme reading, either extreme low. But we were camped down here for weeks. And then we finally are showing some improvement. Now, if we get up to the 75 level or not too far from where we're at right now, this is when we start to think in a contrarian type of way. And we're under 20 with the VIX, so that's been improving. And the VIX of the VIX actually went up a little bit, even though we had a slight up day. But the VIX of the VIX is going up, as is both with the bar chart and the line chart, but we're still below the moving averages. The momentum for the VIX still continues to be down, and we went up with this fear gauge and ticked up just a little bit with this other fear gauge. We're seeing a little bit of fear coming in, and some of this might have to do with interest rates going up over that 4.5% level. Pretty much flat with the daily chart of the equity put call ratio, but we're starting to get extreme here with the 5-day chart, and we're declining with the 10-day chart. So when they're going down, it's positive. But when we go below this red line, that's when we're like, uh-oh, maybe we use this then as more of a sentiment gauge. And this might be when we're getting extreme, even though this ratio or this moving average could still continue to go down. All right, this is improving. The risk on to risk off is going up. This is more positive for the market. And we're seeing an improvement with the high beta versus low beta stocks. That's really going up. And still below the band here when we look at volatility risk premium. And we actually came down. Now the S&P was up, but we declined here with the advanced decline line based on price. We're still going up based on volume. And we're seeing this is part of the negative divergences that I'm seeing right now. We've been going up with the S&P, but we're getting lower readings here with our advanced declines over the last 10 days. Declining a little bit, but still above zero with the advanced decline ratio chart. And we're seeing a little bit of weakness coming in here. It's more of a contraction of the new highs, a little bit of an expansion of the new lows. But now we're crossing below the moving average with the 5-day chart, and we're flat to slightly declining here with the 10-day chart. And this is the version of the chart that I usually use in the newsletter, but it has more stuff on here. Now we're positive if you look at accumulation distribution as being above the red line, and this is smart money indicator number one. That's positive in and of itself, but that may not be good enough for you. So this boom indicator, which I put on here for a completely different reason, also is helping us a little bit with momentum. Now we're above the moving average, so that's positive, but we did roll over a little bit in Wednesday's session. So if this drops below the moving average, then this would be negative. It depends on how aggressive you want to be with this chart. If you're more conservative, you say, all right, we're positive because we're above the red line. If you're a little bit more aggressive, then you're watching this other moving average as well. And if it drops below the green line, then it would be negative. It's positive for now, but declining. And we're actually going back positive with the Chaikin money flow, and we're back to going up with the Chaikin oscillator. So for right now, we're seeing a little bit of weakness in this accumulation distribution, but our three smart money indicators are positive. And the vortex is positive with the green line above the red line. We came down here a little bit. This was the rest of the S&P showing some weakness, but we're still, at least when I look at the S&P chart, but we're also seeing declines with the NYSE common stock, mid caps and small caps, but we're still above these moving averages. And this is another negative divergence. We've been going up with the S&P, now with the stocks above their 20-period moving averages. When we had a high reading like this was that previous chart. It shows when stocks are above their 20-day moving average. That's usually a really good thing. But we are pulling back right now. So that's a bit of a negative divergence there. We're declining with the 50-day, but we're still above 50. So it's positive. Also declining with the 100 and the 200, even though all of them now are back above 50. So they're all positive. Here's the chart where we're above the 200-day moving average. And that was kind of a big deal that we were able to get back above that. And let's see. For some reason, I have, hold it. Okay, this chart didn't get deleted right up here. We're, let me see. Yeah, this was an old chart. Sorry about that. So looking at this chart, this is one thing that I did notice is that this is a pivot point, and this is at about 5,900. And we've been having a difficult time breaking above that. And we're also dealing with an overbought condition. We're seeing some shorter term negative divergences. So this overhead resistance may end up actually being something. But we got a whole slew of reports that are coming out on Thursday that could negate that. And we're coming down with the 20, 50, and 200 period moving averages, but all of these are still above 50. We're still extreme with the Stochk RSI, Williams percent R, CCI 14, and CCI 20. We're extreme with all three time frames here with the stochastics chart. And coming down, but still positive with the force index. The short-term trend still looking good. We're above both the green line and the blue line, and the lines are going up. So that's showing more of a strong-term, short-term trend. And we're above the 20-period simple and exponential moving averages. And here's the rate of change going back 5 days. We're above this blue line. Doesn't mean we have to stop. We just notice it more then. Here's the 10-day chart and the 20-day chart where it had worked off. Now it's starting to get extreme again. And we're in the +3 channel with the standard deviations chart. That's usually can mean that we're getting extreme here. Intermediate term actually declining a little bit with the balance of power, but still well above zero, so that's positive. Extreme positive with the CMB composite, positive with the go, no go with the blue bars now. And seeing the highest high line, that's the blue line, that's going up, and we're above an advancing midpoint. That's more positive. We're positive here with the Landry light and the proper order. That's turning more green. This is really extreme, though. The TTM squeeze, it was already extreme when we were down here. Now it's even more extreme. And you can see this really, really high reading. Way extreme positive right now. And then the bow tie, still showing an improvement. Seeing the fluorescent green above the red, above the blue, that is looking more positive. That's what we see during more uptrends. Standard deviation, we're starting to move again here. So it dropped below the moving average. Now it's starting to go back above the moving average. And again, this doesn't measure direction, it just measures speed. And speed has been picking up lately. We're still positive with the ease of movement, even though it declined a little. And we're starting to get extreme here with the Arun indicator. Now it's coming back down slightly. This is another negative divergence here. We've been going up with the S&P. We're setting a lower high here with the McClellan oscillator, and it actually declined in Wednesday's session. But we're still going up with the summation index based on price and volume. We're also seeing that same negative divergence with the NYSE McClellan oscillator, where this is the S&P on top. So it's not, this is not the NYSE up here. And we're setting a lower high right now as price is, at least in the short term, making a higher high. But we also saw some weakness in Wednesday's session. But because we're above zero, we're still going up with the summation index for the NYSE based on price and volume. And we're getting a mixed picture here. We're declining based on price with the Swenland trading oscillator. We're still going up based on volume. Momentum is still positive, whether you look at just the indicator or looking at price and volume. And we're not extreme here, working off a little bit with the PMOs that are rising, starting to decline a little bit with the buy signals, but we're still going up with the PMOs above zero. Positive with the Elder's Impulse system, positive with the parabolic SAR, really extreme here with the slope oscillator. We were concerned when it was down here, and now it's getting an even higher reading on this chart. The MACD you could make a case that maybe we're getting a little extreme with the MACD, but it's positive. So we're getting a really high reading with the slope oscillator. Our other short-term oscillator still looking good, crossing above the midpoint, above the moving average. We're also positive with the MACD, and again, maybe getting a little poppy here, at least in the short term. But the PMO, PPO, those are positive, and our long-term TRIX and KST oscillators are positive. And again, you could make a case that we're getting kind of extreme here with the Copic curve, but it's still positive because we're getting a very high reading right now. We're positive with the money flow and the ultimate oscillator. We're above the moving average with unbalanced volume. We're up into the green area with the Sean trend meter. We're extreme with the short-term RSI, but we're still looking positive here with the intermediate-term RSI. Now, the short-term, that's okay, but we're getting extreme positive there. All right, then the condition of the intermediate term trend really improving as we're starting to see the red line cross above the blue line as price has been going back up, and we're above the 50 period simple and exponential moving averages. We're above the 100 period simple and exponential moving averages, so we're still above all the plotted moving averages here. The longer we stay up here, the more these lines will start to turn and go back up. But we're far away from the 20 period and 50 period moving averages as measured by the boom indicator, and declined a little bit. We're still extreme with the S&P bullish percent index, but we're still above the moving average. But again, we had kind of an update, not much, but to see this coming down, this also kind of is a little bit of a concern more in the short term. And declining just a little bit with the NYSE bullish percent index, but still going up with the NASDAQ 100 bullish percent index, but giving us a very high reading right now. And we're breaking above the Ichimoku cloud. Now it's red, but the positive part is that we see a green cloud not too far into the future. That'll come out in June. But really, all these are just current moving averages that are shifted forward. We were having a little bit of trouble trying to get above the cloud here. Well, we broke above that. And then the green line's going up. That's short term. That's positive. The blue line is above the red line, and both of those lines are going up. So that is also positive as well. We're positive with the Heiken Ashi, Kegi chart, Renko chart, and three-line break chart. Long term, right about here at the midpoint with the 150 moving average study, it's declining a little bit, but we're still above the midpoint here with the 200-day moving average study. And we're positive in the short term with all stock indexes. And we're switching more to negative now in the intermediate term with the mid caps, small caps, and they continue to be negative in the long term. And bonds are negative across the board based on price here in all time frames, where commodities and the dollar are now in short-term uptrends, where stocks are positive across the board. And we saw tech, communication, and discretionary. These are the three big growth areas, and we like that they were in the lead, and that's what's helping the market to improve. And we saw some red here with the utilities having a bearish MACD crossover. The real estate sector, same thing, a bearish MACD crossover. We did get above 19.1 with the NASDAQ. Utilities, again, this is more defensive, a BPI cross below 70. Then real estate, again, seeing more weakness here, having a BPI cross below 70 after it had been stronger. Healthcare setting a new 52-week low, and the Dow ended up going down below 42,000. And I don't show this very often because this thing can go months and they don't even update it, but they finally did, and then they usually backdate it a little bit. Where we're positive with the decision point scorecard in the short term, whether you use a trend-based model that's moving average based, and then the PMO, which is the price momentum oscillator, those are turning back to positive. We're still negative in the intermediate term, where we're positive with the trend model now, and long term we're negative, where long term we're positive with the PMO signals. Then here's the market carpet here, and a lot of green in here. This is why we're seeing mega caps outperforming. These are the biggest of the big, and tech is really showing an improvement right now. We saw weakness more in industrials, a lot of red here, energy, red, utilities, a little bit of green, but red. And then real estate and materials are actually seeing a little bit more weakness. And we're seeing not Walmart, but the rest of the staple sector is seeing a lot of red right now. And we are going up when we look at the ratio between the S&P weighted index and the equal weight version. We've been just chopping around here for quite some time. If we could keep going up, that just means the bigger stocks are outperforming. And we're now above the 200-day moving average with the Dow, but we are having a heck of a time, excuse me, the 50-day moving average, but we're having a heck of a time getting above the 200-day moving average for the Dow. It hasn't been able to do that yet. And we're neutral with the diamonds, with the Elder's Impulse system. We're above both the moving averages with the NASDAQ. And so that's showing some improvement there. We're positive with the Elder's Impulse system for the NASDAQ. And we're above the moving averages here with the NASDAQ 100. And this is more the growth area in the S&P 500. So when the NASDAQ 100 does well, so does the S&P. And the momentum for the NASDAQ 100 is positive. We're positive with the Elder's Impulse system with the Qs. Small caps finally getting above their 50-day moving average, but bumping into this R1 resistance level now. They were down over 1%, and also down 0.89% with the Russell 2000 small cap index, coming down a little bit after getting extreme with the RSI. The momentum is still positive. So we're seeing some improvement here, but not as much strength as what we're seeing with the large caps. And going to neutral with the small caps with the Elder's Impulse system. Another area, 200-day moving average with the mid caps. Having a hard time getting through that. And we're neutral with the mid caps with the Elder's Impulse system. The Wilshire 5000, this is really improving, getting above both moving averages. And we're above both moving averages with the total U.S. stock ETF. The financial sector is doing okay, even though it was down a little bit over 0.25%. The FANG index, really big stocks here. They're showing some real improvement. And let's see, Apple was down 0.28%, still dealing with its 50-day moving average. Amazon above both moving averages. It was down a little over 0.5%. Microsoft just keeps going up here. It came out with earnings, and that's where we saw the gap up here and it's continuing to go up. Where Google is in a downtrend, but it was up 3.66% here. And Meta, after just generating a death cross, is now starting to go back up a little bit over 0.5%. Nvidia is still in a downtrend. It was up over 4%. So it likes some of the news that's coming out about the trade talks. Tesla also up over 4%, but still in a downtrend. Netflix actually coming back, not quite back to an all-time high again. This ratio going down is positive. That when this is going down, that means staples are underperforming tech. And that we like that. That's more positive for the market. And we're going back up here with the semi to Dow ratio, which is another growth versus value type of study that we have. But we've seen this improve before only to have it come back down. We want this to really go back up and possibly get back up to the blue line there. And we are improving here. This has been a warning sign. We were watching this because we were seeing a real breakdown with the SPY to staples ratio, which is similar to what we saw at the end of 2021. Well, this was more even. This broke down and just kind of kept going, where we were breaking down here, and now we're coming back and actually starting to break back above the rainbow. And then I hadn't shown this in a little while, the gold to SPY ratio. We came right up to this resistance area here, which is a trend line from these previous highs. And we've been coming down for the most part with this ratio as stocks have been doing better than gold. And let's see, fairly strong short-term correlation between world stocks and U.S. stocks, and longer term, the correlation is getting a little bit stronger. Oil is still into the lower 60 range, and the dollar, after coming up to its 50-day moving average, that may have provided overhead resistance. Now it's been coming down, but we're still above 100. And inflation coming in right now at 1.67% according to Trueflation. And I put a red line here because it says 45, but that's 4.5, 4.5%. This is when the market starts to get kind of nervous. The stock market does. So we just want to keep an eye on that one. We're also coming down with the 10-year based on price. And we are improving with our growth to value ratios. Qs to S&P, discretionary to S&P, large cap growth over large cap value, large caps, mid caps, small caps, all above advancing moving averages. So that's improving there. We're starting to go back up with our S&P to utilities ratio. That means the S&P is outperforming utilities. And this is going down when we look at staples to the S&P. And that's more positive when this ratio declines. So what's the outlook for Thursday? We're positive across the board, short, intermediate, and long term. Now, we're still in a downtrend in the long term, but we're above the 200-day moving average, and that's what I use to define positive there. And we got quite a list here. Jobless claims, continuing claims, retail sales, PPI. These are all kind of big deals. Empire State Manufacturing, not as much. Philadelphia Fed, not as much. Industrial production, capacity utilization, it can have an impact, but it'll probably get dwarfed by retail sales and PPI reaction. Business inventories and the NAHB Housing Market Index, and then Fed Chair Powell is going to be speaking. And he could override anything that these reports say, because that's seen as the most important thing right now. But we'll just keep an eye on what's coming out of Washington, what's happening with the trade talks and the trade war and tariffs and all those other things as well. And then here's the big long list for Thursday. The big one on Friday is going to be consumer sentiment. And let's see. Oh, I should have changed this. Oh, I did change it. Yeah, okay. Pretty long list of things that are coming out in Thursday's session. We're positive with the Dow for May 15th. We're neutral to positive with the S&P, neutral to negative with the NASDAQ. But we are dealing with options expiration week, where it's a little bit more negative than positive. But during a post-election year, this is a kind of a positive time. Seasonally. Doesn't mean we're going to go up, but we have in the past and during a post-election year. So this could be positive. Here are the pivot points for Thursday's session. I'm also going to be they've already been posted on the YouTube community tab. All right, so we're still concerned longer term with the growth to value ratios, but it is improving. We're above both the moving averages, and we're seeing an improvement here with discretionary to staples, but the long-term trend is still negative. We're getting a mixed picture with the swing trading oscillator, and we're still negative but improving with the special K chart. And now I put these back on the positive side. Accumulation distribution, Chaikin money flow, Chaikin oscillator. They are now positive. We're still above the moving average, even though we declined with the boom indicator slightly. And we're positive with the S&P and NYSE McClellan oscillators and summation indexes. The bullish percent indexes are positive. Parabolic SAR, the moving average studies are all still above 50. Momentum is still positive across the board. Ease of movement, money flow, ultimate oscillator, as well as the vortex are positive. And I like to point this out. Gold, these are primary indicators, where if they're white, that's more of a secondary indicator. Financial sector is positive, and the momentum for the NASDAQ 100 is positive. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. So our conclusion, we're still positive across all time frames, but we're quite overbought now in the short term, but we've been that way for a few days. Are these negative divergences, is this going to develop into something? And that could be some of the weakness. And to see things going down on an up day, even though it was virtually unchanged, we're seeing a little under the surface weakness developing, not only in the short term, but in the intermediate term, where we're now back to positive in the long term since we're above the 200-day simple moving average, but we are still in a downtrend. Thank you. I really hope you found this helpful. Have a great day, and I will talk to you in the next video.